Now let's work out with one of the most critical aspects of evaluating any project, wherein we end up computing the free cash flows for the project and also the free cash flows for the equity investor. Now, what do we mean by the free cash flow for the project? See, there is the cash flow statement which we are talking of. But what we are saying by the word free cash flow is, what is that amount of cash that is available with the project after paying off all the costs of the project, all the required expenses of the project and all the required asset purchases, whatever it is, what is the cash that is left so that it can be paid to either the lenders or the equity investors. That is what we talk about the cost, the free cash flow to the firm. What is the cash that is available with the entire project in each of the years after it has paid in all the necessary costs and also after it has taken care of the entire capital expenditure kind of scenarios without doing any investments or anything. What is the cash that it is left with so that it can distribute it to its lenders as well as equity investors? That is what is typically being called as the free cash flow to the firm. And out of that, if I take out the interest and the principal repayments, they are the ones that are benefiting the lenders. So if I take out the free cash flow to the firm minus the interest repayment as well as the principal repayment, I am going to get free cash flow to the equity. So using these things, we will actually find out what is the return on this entire project, what is the project return, or sometimes people call it as project IRR, or we are talking about what is the return that the equity investor is going to generate, which we call as equity IRR. These are the two key calculations as a part of evaluating the worthiness of the project. So that is what we are going to look at now, creating these two cash flows, free cash flow to the firm and free cash flow to the equity. Generally, the way people look at the free cash flow to the firm is free cash flow to the firm comes out as EBIT into 1 minus T, because tax portion of the free cash flow goes to the government. So probably the simple way to look out for is the PAT, whatever we have got. To that particular PAT, you add up the depreciation, because that's a cash part, and you add back the interest post the tax part. Or for simplification, you can even say I add back the interest. So this thing, or the simple way is whatever the cash flow from operations you have got, which is nothing but PAT plus depreciation, to that amount I add up I into 1 minus T, which is the interest adjusted with the tax, and from this I subtract the capital expenditure. And here we don't have any capital expenditure for this particular project in the middle, so we don't need to bother about any capital expenditure in each of the cases. So all I can do is CFO plus I into 1 minus T can generate my free cash flow from the firm, free cash flow to the firm. So let me use